Well, good morning, everybody. I got to say, I'm very pleasantly surprised at the turnout at 8 o'clock in the morning on a Tuesday in the Windy City to start the Benzinga Cannabis Capital Conference. Wow, you guys are incredible. Give yourself a round of applause. That's impressive. So I think this is our 9th year of doing these sessions on deals and where the money's going and who's buying whom and how companies are being valued in the industry. And want to thank our friends, and I mean that sincerely, our friends Patrick Lane, Elliot Lane, and Javi Haas, who have carved out, after all these years, among the OGs that still exist in this industry, and some don't, as you know, Benzinga has become the cannabis capital markets event in the industry. And so I want to applaud them and thank them for all their work over the years. Thank you, guys. Applause for Benzinga, Patrick, Elliot, Javi. Thank you. They've been very generous to us. We've tried to do the same with them, and I just want to recognize their work in the industry. So, over 10 years ago, June of 2014, we launched Viridian Capital. I'm going to be quick, Frank. Frank's going to get to the meat of the presentation. I'm just here to do the song and dance. But first investment bank, corporate finance, M&A practice in the legal cannabis industry. Done a bunch of deals around the world, raising debt, raising equity, buying and selling companies, coming off a couple of tough years in the capital markets, as I'm sure all you know. Equity was down, debt was down, M&A down, but we feel that we're coming out of it. Frank will go through the specific data as to who's raising money and where the money is going and who's buying whom. I'm going to jump into a slide. How about that? So one of the cool things about being so early in a new industry as we were, we launched in June of 14. By October, we started getting a lot of calls from newly licensed operators in the only legal states, Colorado, Oregon, Washington, California. There was no East Coast market. It was all, the West Coast market. And these licensed operators, they must have found us in the phone book. I don't know where they found us. But they got a license. They had 9 months to stand up their grow. They had to raise money. And we would get calls saying, I don't know what my company is worth. I don't even know how to value it. I don't know what a deal looks like. How much of my company do I have to give away to raise $1 million or $10 million bucks? So they called us asking to do valuations. And I said, yeah, sure. I've been doing this stuff for, at the time, 20 years. So I looked for a comparable company database of deals to see who was raising money and what's the structure and what's the terms. And it was a zero. It didn't exist. Bloomberg wasn't covering the industry. PitchBook wasn't covering the industry. So one of the cool things about being early in a market as evolutionary as this, we created the first database of capital markets deals called the Viridian Cannabis Deal Tracker. How many of you guys are subscribers or readers or know of it or don't care? Okay, some mixed there. Thank you, everybody. So we launched the Viridian Cannabis Deal Tracker in January of 2015. We're 9.5 years into this. We've covered about $75 billion in deals, about 6,500 transactions. We know where the equity investors have invested and how and what structure. We know how the lenders have lent and how and what structure and what cost of capital. And we know how the acquirers have acquired and where and what state and what type of business. How did they value revs? How did they value EBITDA? And what's the structure? That's the Viridian Cannabis Deal Tracker. We're really proud of it. It really is our calling card, probably our best asset, other than our people, is the knowledge about how deals are done and structured and termed and valued in the industry. This is really the asset of Viridian Capital Advisors. About 4 years ago, we brought on Frank Colombo that kind of took the tracker to a whole other level. And for those of you who get the tracker every day, you know that we talk about, I think there's a pointer here. Yes? Does that work? I don't know. Deals by industry sector. So where's the money going? Is it biotech? Is it brands? Is it cultivation? Is it retail? Packaging? Software? So we track the flow of capital and the change in the flow of capital by sector to try to get ahead of changes in Some sectors are in favor, some are not. Same thing with deal structure. Is it equity? Is it common stock? Is it preferred? Are there dividends? Is it convertible debt? Is it straight? We're digging into structure and terms and valuation to try to understand how the flow of capital is changing over time. We launched the first credit rating system in the industry, thanks to Frank. So you have, I don't know how many tens of billion dollars worth of debt that has been taken down by GTI and Verano and TerraSend and you name it. Much of which is publicly traded right now, publicly traded cannabis debt. There's no rating agency. S&P and Moody's do not cover the cannabis industry. It's too out of the mainstream for them. Well, we do. And we came up with the first credit rating system. I'm going to fly through this. So we put out our market reports every day. This is not easy. Monday's the chart of the week. What's new in the land of cannabis capital markets and structure that's important for our readers to know? Tuesday is the sector tracker. Wednesday is Viridian Insights. Thursday is the credit tracker. Friday is the valuation tracker. So we've invested in our people. We've invested in our analysts because tracking every deal in the cannabis industry globally is really a lot of fun, very valuable, puts us in a position to properly advise companies and investors and acquirers and boards. But we have to continue to invest in the platform, and we have. We're also adding some new features. We do special reports now. Some of you probably remember we've done 2 partner reports with Ernst & Young, EY. We're doing the same thing with Dentons in Germany, the largest law firm in the world, has a large cannabis practice in Germany. We're working on a joint report for them, with them. And we're also starting to add what we call, I don't know how to do this clicker, guys, but it's not there. Look backs. So if you're a subscriber to our data, to the Viridian Cannabis Deal Tracker, you can now look back on all of the M&A deals over the last 6 months. By California, by Chicago, by Germany, by Colombia. You can look back at all equity deals. What was the structure? What was the value of enterprise value to revenues or EBITDA? So we're opening up our database. We've never done this before, but we're opening up our database so subscribers can look back and do trend analysis over time. Which investors came in, which lenders came in, where are the acquirers acquiring or not, and how are they valuing companies. So we're adding all of these new features to remain actionable and to make sure that the Viridian Cannabis Deal Tracker remains the leading and the largest cannabis deal database in the world, which it is today. And we are evolving this finally after 9.5 years to a subscription model. So people can pick and choose what type of data they want, whether they want the 6-month look back. We're creating a lot of flexibility in the access to our content. So I'm going to hand it over to Frank to talk about the good stuff, but I want to thank Benzinga again. This is the most important conference in the world where, as their tagline says, deals get done. So thank you, everybody. I'm going to hand it over to Frank.
Thanks. I'm going to go through quite a bit of material pretty quickly. The slides are available. We're in booth 502. If you want to get a copy of the slides or you have questions, just please come by. This first slide, I'm trying to put things in context. How is capital raising in cannabis happening now over this year in a historical context? This slide is worldwide capital raises for all sectors of cannabis, meaning biotech, hemp, software, and the big one, cultivation and retail. What you can see is in 24, this is for the first 39 weeks, we're up slightly for the first time in 3 years, but just slightly, 14.7%. It's actually went up to 14.8 this week. So a slight increase. And when you dig into that, there's really two sectors that are driving that. There's Canadian equities and US debt. Everything else is kind of a non-event. US equities, for instance, were up 6%. Not much of a move. Also on this slide, I want you to note that debt continues to be more than 50% of all capital raises. That's the red line. And the US has come back to being about 70% of capital raises. That's the blue line after a dip last year. From a sector point of view, we break the sectors down into 12 different sectors. And cultivation and retail, the licensed operators is always the biggest one. It's about half of all capital raises. It was down about 14% this LTM period. One of the only sectors that's really up very much is investments in M&A. You can see that orange bar in the middle. That was due to the IPO of Mercer Capital SPAC. Now, when you focus down on U.S. cultivation and retail, the licensed operators, you see a dramatically different story. Capital raises are actually up 226% year to date. Okay, and that's when you look at that, the red line on the top shows you that that's debt compared to capital raises, and you can see that debt was virtually all of capital raises this year, 97% of capital raises. The peach bar at the top is large deals, large debt deals, over 100 million. The blue bar is slightly smaller, 25 to 100 million. And what you can hardly see at the bottom, the green, is equity raises. It's almost nothing. And there's some reasons for that that we will get into momentarily. But the natural question is why, let me make one other point, which is of that debt raise, the vast majority of it, 7/8 of that has been refinancing. So out of the 830 million of new debt, there's only been like 120 of new money. So obviously the question is, why has there been so little new money coming in? What will it take to change that? And where should you position yourself as it does change? One of the reasons that not much new debt has come in is that many MSOs are over-levered. Now, we've taken up some new measures of debt and of enterprise value. So our measures of debt now include leases. They also include what we call excess taxes. So if you have accrued taxes on your books, more than 90 days worth of your tax expense, we count it as debt. And the reality of it, it is debt. You might get lucky and the IRS may not have you pay it all back, but for now we count it as debt. And you can see that on the graph on the right, a great number of people are over 3 times debt to EBITDA. We're also using EBITDA here rather than EBITDA because if you're going to consider leases as part of debt, you need to add back that rent expense or the operating lease expense into your EBITDA calculation to be fair. So we do. So the upshot is that even when you look at 25 numbers, which both of these graphs are based on 25 estimates, still a great number of companies that are over-levered. And the other thing to take away from these graphs is when you look at an EBITDA compared to an enterprise value that includes all this extra debt, the hidden debt, the industry isn't quite as undervalued as it appears from traditional measures. So we think that the old measures of enterprise value to EBITDA and debt to EBITDA are just not really very appropriate for this industry, given the prevalence of debt, and, leases, and taxes. Now this graph, you might have seen this graph yesterday as it was our chart of the week. This graph is another reason why capital raises have been so low, which is looking out in 2025, the black line is EBITDA, and all those boxes stacked up are all the uses of cash. You have interest expense, you have taxes, you have rent, you have CapEx, you have debt repayments. And what I want you to focus on is the red bar. The red bar, the black bar at the very bottom is what we estimate taxes would be without 280E. And then the red bar adds in the effect of 280E. So we are, to notice, right now, if you look at the graph the way it is, only about 5 out of the 14 companies in here actually have enough EBITDA to cover all of these fixed charges. It's close, and when you add in cash, which is the top line, most people are okay. But importantly, when you add back that red bar, if you say 280E goes away for tax year 2025, then everybody on this list, with the exception of Schwaz at the right, looks like they have more than enough EBITDA to cover all their obligations. So once again, why no capital raises? Because they don't really need them. The capital is self-funding for a lot of these players for 2025. Now, I want to remind you, 2026 is an entirely different story. There's a huge debt wave coming, of maturities coming in 2026. So we think that as these companies rejigger their balance sheets, credit analysis is going to be continue to be a huge part of equity research. In fact, as important as traditional equity research. But you can't rely on simple measures like one number of measures like debt to EBITDA. You really have to go beyond that. And our credit model takes into account 11 different ratios, including some market-based ratios that are based off of stock prices, which we think is important because our model changes every day. Our ratings for companies change every day as stock prices change. And we think that's important. So, don't wait for quarterly earnings to come out. By the time they come out, everything has already moved. It's too late. You got to be ahead of that. So, in the end of the day, this is a graph that shows you where multiples have been compared to past legislative events. The bar on the right, 7 times, is the top 11 MSOs compared to next 12 months EBITDA. And this is a traditional measure, enterprise value to EBITDA. We think that that should be way up from where it is, but the market is skeptical, right? Nobody wants to believe anything about S3 or SAFE or Garland memo or any of that stuff until it happens, which is why you haven't seen any equity issues. If you go out to raise equity right now, the market, you're going to be met with suspicion. Like, why would you raise money now? That's the market's reception to somebody that wants to raise equity right now. But there will be a moment when some of these catalysts start to happen, that stock prices start to move up, and there'll be an opportunity for these companies to fix their balance sheets, to also take on extra capital for big projects like Florida expansions and whatnot. So we think that there is a real chance for at least a double or maybe a triple. You can see that triple would be in the scope of this graph. But where do you want to be? Okay, for the near term, we think that the most appropriate equity stance to be in is don't step in the proverbial dog shit. Credit problems have been a big part of the equity downturn on a lot of the people on that graph that we showed before. So you just need to avoid really the disasters. And if you can do that, you're going to get the rising of all boats as these catalysts start to happen. So pay close attention to credit analysis. We believe that the appropriate thing is a laddered approach. You should really stick primarily to the companies that we rate as the better credits, the top 10 out of the 30 that we rate every week. But selectively, there is a place for some speculation, and we'll be happy to talk to you about where we think that should be, what companies. But there are a few companies that are a little bit dicier credits that have huge optionality. You guys know who they are. Optionality to Florida, optionality to S3, optionality to SAFE. Companies whose are likely to be okay in the near term, and they are likely to scream on these catalysts. So that is kind of where we think you should be positioned. Happy to answer questions. We don't have much time here, but if you come by our booth, we can talk about this. You can get a copy of the presentation. So this is kind of just a summary of what we just all went through. We think that it's an exciting time. We've never had so many positive catalysts available, and any one of them, especially S3 because it affects cash flows. But S3 and SAFE together could get you uplisting. S3, SAFE, and Garland probably get you uplisting, and that is exciting. That's a triple. So thank you.